Hi, everybody. This is David Gully, and this is the August 2023 Monetary Policy Update. I'm from Bentley University. We have a whole YouTube channel. Please check us out at Bentley University EC391. Our agenda today, we're going to talk about the Fed's recent monetary policy actions. We'll do a summary of the labor market. Then we'll talk about inflation, and we'll talk about the currently new hip and trendy measure of inflation called Supercore. We'll talk about the impact of policy changes on the economy and talk about what are known as long and variable policy lags. This has become also very trendy right now. And then finally, we'll close with what the Fed might do next. So the Fed has done three things over the recent couple of years here. So since 2022, March, they've increased the federal funds rate 11 times. The balance sheet has continued to decline. They are now running the balance sheet off at $95 billion per month, 60 billion in treasuries, 35 billion in mortgage-backed securities, though this was interrupted by the SVB banking situation in March 2023. And then finally, their forward guidance, in other words, what they're telling us about what they're going to do with policy in the future has become much more vague. And the idea here, it's harder for the Fed to know what to do from here on out. Even 6 or 8 months ago, it was easy for them to know what to do, to raise the federal funds rate and to continue to tighten policy. That's not the case anymore, and so they become more vague, and we'll give an example of that in terms of how they've changed their language. First, here's the federal funds rate. You can see the step function. So right here this is March 2022, their first interest rate increase in a number of years, and you can see the very, very steep policy path here, the federal funds rate. Those large steps are 75 basis point increases, and so that was a historically quick rate of increase of the federal funds rate. But you can see since 2023, they've slowed the pace down somewhat, and this goes back to the idea it's a little bit harder to know what the right thing to do is now because, for example, inflation has fallen pretty dramatically. Here's the balance sheet. And so you can see the rundown of the balance sheet. Again, now, as I mentioned, this is 60 billion a month in treasuries and 35 billion a month in mortgage-backed securities. But the bump right here, this is the increase due to the Fed expanding its lending programs. It made use of the discount window, and they introduced a new policy facility, the Bank Term Funding Facility, to help banks deal with the decline in market value of some of their treasury securities. But notice here that with what they refer to as traditional securities, and here these are mortgage-backed securities, those continue to decline. And probably over time, the lending will decline as well. So the balance sheet is shrinking now roughly at about 95 billion per month. And so let's give an example of how the Fed's forward guidance has changed even within the last year. So for example, here's their January statement. So the committee anticipates ongoing increases. They're telling us that the federal funds rate is going to continue to increase, and the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to get to their 2% objective. Now contrast that to their most recent statement just a few days ago. The committee will continue to assess additional information and its implication for monetary policy. So they're not telling us there are going to be ongoing increases. And the idea, again, is it's now difficult or more difficult for the Fed to know what to do given the amount of policy tightening it has already undertaken. So now let's turn to the labor market. A quick summary here. Overall, we got some good visuals here in a second. It's holding up very, very well. There have been some issues with the banking and the tech sectors, but overall, still things are going pretty okay here. And Jerome Powell made it clear in his last press conference that he believes the supply and demand imbalance in the labor market has fallen. So here's the standard U3 unemployment rate, and you can see it's been hanging around, about 3.5, 3.6% here for the last month. That's down notably from the pandemic high of 14.7%. And so there's not much action right now in the unemployment rate. However, there's action in other labor market variables. So for example, here's non-farm payroll growth since May 2021. And right here is the July figure that just came out just this last Friday here. That's 187,000, which was a bit lower than expected. Notice here, this is the May and this is the June figure. Both of those were revised downward from their initial estimates. And the idea is that what tends to happen is when the labor market is slowing, you tend to see these downward revisions. But notably, what we see here is notice the downward trend. The labor market certainly by no means has collapsed, but job growth has slowed very, very notably. So here's data from JOLTS. This is the Job Openings and Labor Turnover Survey. So we have, this is JOLTS. This is a really helpful data source maintained by the Bureau of Labor Statistics. And so the top red line here, this is job openings. And you can see job openings have reached historic highs, but have now started to decline. So the Fed is trying to take, I guess, the edge off of the labor market in terms of one measure is that job openings are extremely high, which suggests that the demand for labor is extremely high. So still, openings are high historically, but they've started to decline somewhat. And then the other two lines, the top line right here, the dotted line, I guess the dashed line, that's hires. Hires have slowed somewhat, but notice that the dotted line right here, separations, has not really increased very much. And so overall, the labor market is still in pretty solid shape, though it has slowed down or some of the edge has been taken off. Wages are another important indicator of the pressures on inflation. So for example, this is from the Federal Reserve Bank of Atlanta. And so the blue line right here, this is blue line, that's the overall wage growth. And you can see that started to slow in the last few months. And then what I've done is I've broken it down by wage growth for folks who have switched their jobs, so a job switcher. And the other line here, job stayers, that's the lower sort of brown red line there. And so notice that the rate of growth in wages for job switchers, the great resignation, people moving around a lot and changing jobs, wage growth there has slowed down very dramatically and is now in the ballpark for job stayers and the overall figure. So wage growth has slowed down somewhat. So this should help put some downward pressure on future inflation going forward. And then we also have the some interesting movement in the labor force participation rate. So this is what's called the prime labor force participation rate. So this is for people aged 25 to 54. And so the idea here is that folks in that age group are very likely to be finished with school and not yet retired. So they're the most likely group in terms of age to be in the labor force. And you can see here, most recent data, the participation rate of prime age workers has reached a multi-year high. So in terms of the supply of labor, relatively strong wage growth and a good overall economy has brought more people back into the labor force. And notice that's increased very dramatically from the post-pandemic low that was right here. Let's turn to inflation. As we'll see, most measures of inflation have declined very notably, which from the Fed's point of view is really good news. Though we want to be a little bit cautious here, is perhaps the easy part of the job in terms of getting inflation down to where it is, which is great. It might be more difficult to get inflation down closer to or to the Fed's 2% goal. In fact, Jerome Powell, in his most recent press conference the other day, made it clear that we, quote, have a long way to go. So here's the consumer price index. And so the blue figure, the blue line, that's the headline figure. The red line is the core figure that excludes volatile food and energy. So you can see here our most recent CPI reading. It now came in at a 3% annual rate. And so you can see the dramatic decrease even in the last 6 to 8 months here. Though the core figure has also come down, it's a little bit more sticky. And we'll talk about some of the reasons why the core measure of inflation, when you exclude food and energy, why that's a bit more stickier. In other words, more slow moving than the overall headline figure. PCE inflation, this is personal consumption expenditure inflation. So remember, this is from the GDP calculation, C plus I plus G plus net exports. This inflation measure measures the inflation of all the things that we buy, not just a relatively small basket that's measured in the CPI. And so here, so this is a broader measure, you can see the same general pattern, though notice here that the vertical axis is shifted downward somewhat. So in other words, the PCE inflation never rose as high as CPI inflation. So you can see now that the headline figure has gone down to also about 3%, and the core figure also declining, but again, more sticky. And then here we have what's called the trimmed mean personal consumption expenditure inflation. And this is from the Federal Reserve Bank of Dallas. And what we do here, remember, is that an average, which is how the PCE and the CPI inflation rates are calculated, averages are influenced by outliers, either on the high side or the low side. And so what the trimmed mean PCE does, it throws out the goods and services that gained the increase in price most rapidly, throws out the prices of goods and services that declined or grew most slowly, and effectively looks at the middle goods and services to see, well, what did they do? How did prices of those non-extreme goods and services change? And so you can see here that sort of the typical measure of goods and services, there, inflation is now substantially under 3% and is heading down toward the Fed's objective. So all measures of inflation have improved pretty notably. Let's take a look at one example of why core inflation, in other words, inflation excluding food and energy, why that tends to be relatively sticky or slow moving. So let's take a look at the shelter component. So this is rent, this is also owner occupied rent or owner equivalent rent, and that's a measure of what it would cost a homeowner to rent the home that they're living in. So it's sort of an unusual measure here. And here what happens is, let's just focus in on people who actually pay rent. They rent an apartment or they rent a home or something. And the way the measures are calculated is they include not just, and this is the important part, not just brand new leases that people sign in, let's say the current month, but they also include the leases that were signed over the last 12 months. And so people who signed leases at very high rental rates, 10 months ago, 11 months ago, even 12 months ago, those are still included in the shelter figure. And so that helps continue to elevate both the CPI especially, and then to a lesser extent, the personal consumption expenditure inflation measure. And so here's the idea. If rents drop, and if they drop rapidly, it's going to take a while before that gets reflected in both the CPI and the PCE. And so this, for example, is why supercore inflation, which we'll talk about in a second, why that's gained a bit of a following, or at least gotten some attention. But here's the way to think about this. And so the blue line right here, right there, this is up through April and March of April of this year. That's the rent of primary residences. This is owner's equivalent rent. So this is for people who own their homes and what they would pay if they rented it in the CPI. And so you can see that that started to increase in 2021 and has continued to increase well into 2023. Yet, when you look at an alternative measure, this is rents of single family homes. Notice the very rapid increase, but now the equally rapid decrease. So you can think of this, it's not exactly correct, but it's in the ballpark. This is rents on the margin. So on the margin, over this period right here, rents were rising very rapidly. But on the margin, this period right here, rents have been rising much more slowly. Eventually, this will show up in the shelter component of the CPI, and again, also the CPI, but it will take a while. So that's one reason why core inflation is more sticky. And so this leads us to supercore inflation. So this has gotten a lot of attention. It's been mentioned at Jerome Powell's press conferences, for example. And the definition of supercore inflation is non-housing. So it's excluding the measures that I just talked about in the previous slide, core services. So it excludes goods as well. And so this is certainly a narrower measure of inflation. The problem here is that this particular measure of inflation is particularly sticky. And so just some recent research here, I'll show you a visual in a second, Ledoux and some other folks at the San Francisco Fed, they find that the Phillips curve using that measure of inflation is very flat. And here's what that implies. If you have a very flat Phillips curve, and I'll talk more about the Phillips curve a bit later here, if you have unemployment on the horizontal and inflation on the vertical axis, measured by Supercore inflation, and you have a flat Phillips curve like this, if you want to lower inflation, you can do that, but it will be relatively costly in terms of higher unemployment. So that's somewhat concerning. So here, for example, is a visual from their recent work. And so they've broken this out into the various different components here. So the yellowy line, this is core goods inflation. The green line is core services inflation. And then the blue line here, this is Supercore services. And again, this excludes any shelter measures, rent, owner's equivalent rent, and so forth. And the key here is that notice that services inflation, either core or Supercore, is relatively sticky. In other words, it hasn't, for example, declined at the rate that goods inflation has declined. So what this suggests is that some components of inflation to bring down might take more work. In other words, more effort, more contractionary policy on the part of the Fed. And then finally, let's have a look at inflation expectations. This is measured by the Federal Reserve Bank of New York. They survey households every month, and they gather data on 1 year ahead inflation, 3 year ahead inflation, and then 5 year ahead inflation. So notice that 1 year ahead inflation, which moved the most, is now rapidly declining. But fortunately, for example, 3 year and 5 year inflation have remained, in the Fed's verbiage, relatively well anchored. And from the Fed's point of view, this is really good news because this helps suggest that with actual inflation anchored, that actual inflation is less likely to increase, meaning if people expect lower inflation, they will not ask, for example, higher, grossly higher wages and so forth. And so that helps keep actual inflation from rising too much. So let's now turn our attention to policy lags. And so Jerome Powell and, in fact, all the Fed officials have said, look, we have slowed down our pace of policy hikes, our increases in the federal funds rate, because what we want to do is we want to gather information about what our past actions have done. So we have to wait to see what our past actions have done, and that will inform us in terms of what we want to do going forward. And here's the thing to keep in mind. So Fed actions, either actual policy moves or even just anticipated policy moves, those impact financial markets really quickly. So I'll give you a visual here in a second in the year Treasury rate. The impact, however, on the real economy, in other words, consumption, investment, exports, and imports, and so forth, that happens much more slowly and with much more variation in terms of when it happens. And so this is the very famous long and variable lag problem. So here we have, this is the federal funds rate and the 2 year Treasury rate. So the federal funds rate is our step function. So we saw this is the same visual we had just a few minutes ago. And our blue line here, this is the 2 year Treasury rate. And notice that they generally trend up and down together. However, there are some interesting timing differences. So for example, notice that the federal funds rate, so here is right here, that's March 2022, the first increase in the federal funds rate. Notice that the 2 year Treasury rate was already about 2.5% at the time the Fed made its very first half point policy move. So the idea is that by the time the Fed actually increased the federal funds rate, financial markets had already anticipated that there would be an ongoing series of increases. And of course, looking back, they were correct. And so the crucial point here is that anticipated policy changes are reflected in financial market prices even before the Fed takes actual action. Now, let's look at the impact on the real economy. Here, there's lots of reasons to think this is a lot slower. Let's, for example, consider changing consumption patterns. Consider people buying, for example, automobiles. Lots of people buy automobiles using financing, so they borrow money to buy the car. Well, higher interest rates will, over time, impact people's car buying habits. In other words, everybody doesn't either run out and buy cars now or stop buying cars right now. It's a relatively gradual process. Likewise, an increase in interest rates in a contractionary policy environment, that will work to, on average, slow down investment. Firms will undertake fewer investment projects because, for example, the net present value of these projects has declined. But those changes, those policy changes, impact investment only over months or perhaps even years. Consider the change in net exports. Changes in monetary policy are well known to impact exchange rates. Exchange rates, in turn, impact imports, goods and services that we buy from other countries, and exports, goods and services that we sell to other countries. So even though, however, the impact on exchange rates might be really fast, the impact on the exports and the imports themselves happens also over months or perhaps even years. Another example, consider fixed rate mortgages. Mortgage rates in the current environment have increased pretty dramatically over the last several years. However, lots of people have a fixed rate mortgage that is still, in the 2s or even in the 3%. So those folks are relatively less impacted. Over time, relatively more people will be impacted by, for example, higher mortgage rates. So those higher mortgage rates will take time to impact the housing markets. And then finally, consider rent contracts. We mentioned those a few minutes ago. On the margin, rent contract, rent prices have slowed very dramatically. Some markets, they've even fallen a little bit. But on average, they're still held up by previous year's rents. So here's the idea. Changes in economic activity take a long time, and that time period is very variable. That's the long and variable lag problem. So, for example, consider interest rates and how changes in interest rates affect household behavior. So this is a chart from the Wall Street Journal just a week ago. Share of household debt that adjusts with market interest rates. And so notice how dramatically that figure has declined. So consider 35 years ago, roughly a third of household debt fluctuated up and down in terms of the interest cost when interest rates changed. Now it's roughly, around a little bit here, only about 10%. So relatively more households have fixed debt contracts, and these take a longer period of time to impact or to be impacted by monetary policy. So here's the idea, is even though the Fed started tightening policy as measured by the federal funds rate in March 2022, we are still perhaps relatively early in the game. But if we look at what they did, for example, with their balance sheet, they started moving the balance sheet down prior to March 2022, and they telegraphed with forward guidance that they were going to increase the federal funds rate. And so policy probably started actually tightening in 2021. Here's the problem, though. If you look at just the federal funds rate, it did not move above what's called the neutral rate until mid or even late 2022. The neutral rate, that's the interest rate that neither is expansionary nor contractionary. And the Federal Reserve estimates that, at least measured by the federal funds rate, at about 2.5%. So the policy rate, as measured by the Fed funds rate, is only moved above that neutral rate by roughly, let's call it a year. And if the general range of estimates of the 12 to 24 month range are accurate, we're only in the relatively early stages of those policy changes. But some folks, like Christopher Waller, suggest that, well, maybe policy changes act more quickly than they used to. In other words, maybe there are various reasons why the 12 to 24 month range still works, but now perhaps we're a bit closer to 12 than we are 24 months. So Chris Waller gave a very interesting speech very recently, and he gave two reasons why these lags might be shortened. And we sort of mentioned or hinted at one of these. So first of all, forward guidance. In recent years, the Fed has been very aggressive about trying to tell us what they're going to do with policy so that financial markets and folks can anticipate and prepare for and deal with policy changes that are going to come. Consider, for example, the two-year Treasury rate that we talked a few minutes ago about. We showed that the two-year Treasury rate had already increased to 2.5% by the time the Fed first increased the federal funds rate back in March 2022. So financial markets, to the extent that they can anticipate and act on those policy changes, financial market conditions will adjust much more quickly, and that will help policy transmit more quickly through the economy. The second thing to keep in mind is this. Consider the Fed's recent policy moves beginning in March 2022. They have been very large and they've been very fast. And that's going to be important. Because consider this. Let's suppose that a policymaker, a central bank, for example, made a small or made very slow changes. It's very possible that decision makers might not pay attention to those small and or slow changes because they're very gradual and they might be hard to notice. But suppose, though, there are large and fast changes like the Fed has been undergoing here in the last year and a half. What they might do is they might pay a lot more attention to those large and fast changes and change their behavior, meaning changing their spending, firms adjusting their prices more frequently, and so forth, than if the changes were small and or slow. And this is the idea of where rational inattention models come in. So in other words, people and firms do sort of a cost-benefit analysis because we have limited, mental capacity to pay attention to things in terms of, well, do these things matter and what do we do about them? So a small, slow change in, for example, monetary policy might not be worth paying attention to. But large and fast changes in monetary policy are worth paying attention to. And once people and once firms start paying attention, they adjust their behavior more quickly, right? And so this is one of Waller's fundamental points. And so here's an implication. If firms, for example, start changing prices more frequently, because if there's very low and stable inflation, firms might not change prices for months or perhaps even years. But when inflation is higher and more variable, they will change prices more frequently, both on the upside and in our current environment, perhaps on the downside. And so the critical impact here is if firms change prices more quickly, the slope of the Phillips curve gets steeper. And if the slope of the Phillips curve gets steeper, what that means is that as inflation falls, there's going to be less of an impact on unemployment. So the cost of lowering that inflation will be smaller than if firms changed prices less frequently. So let's draw a picture of this, right? So take a look at contractionary policy. So what contractionary policy does, remember, it's a contractionary monetary policy that will lower aggregate demand. And so what that will do is push inflation down and tend to push unemployment up. And the question is, how much of each of these things will adjust or will absorb the shock, the decline in aggregate demand? And so let's suppose we have a situation where firms are adjusting prices very quickly. If this is the case, we will see inflation fall a lot and a smaller rise in unemployment. In other words, inflation will take more of the shock. And so if this is the case, if we have a Phillips curve here, the way the Phillips curve is drawn, we have the inflation rate on the vertical, we have the unemployment rate on the horizontal. So if firms change their prices relatively rapidly, then we would see the red Phillips curve. So we'd see a relatively large decrease in inflation and a relatively modest increase in the unemployment rate. On the other hand, if firms didn't adjust their prices, most of the shock in aggregate demand would be felt by an increase in the unemployment rate. So here, instead of the red Phillips curve, we'd get the green Phillips curve. So the Fed can get inflation down, but in this case, if firms adjust their prices more slowly in the downward direction, we'd get a larger increase in the unemployment rate. So if Chris Waller's right, then we're more likely to observe the red Phillips curve and have a smaller cost in terms of higher unemployment. And so, of course, this is what we all hope, obviously. So if Chris Waller's right, there's a good chance that the inflation that we still need to get rid of to get down to 2%, that won't do much damage to the economy. In other words, it won't raise unemployment very much. But there are some complicating factors here. Suppose that policy changes, monetary policy changes, are not hitting two particular sectors that are either susceptible to policy changes, or not either, I'm sorry here, both susceptible policy change and responsible for higher inflation. So here's what you want. You want the industries or the sectors of the economy where inflation is being generated. You want those sectors to be most susceptible to inflation, or excuse me, to policy changes. Because if those sectors that are generating inflation are most susceptible to policy changes, that means policy will be very effective. But what if it's the opposite? That the sectors generating inflation are the sectors that are relatively unaffected by monetary policy. Well, if that's the case, then you may need more tightening than you might otherwise think. Well, this is from an article out of the Wall Street Journal just a few weeks ago, and this was done by an economic consultant, and they used the example of the ECB. But the general rule here, the general idea still would apply to any economy. So let's take a look at the top chart here. Okay, right here. So this is the estimated impact on the Eurozone's economy, Eurozone's economy's output, from a 1 percentage point increase in the European Central Bank policy rate. So the idea is, suppose they increase their policy rate by a percentage point. By how much will that impact output of these different sectors here? By the way, ICT, that's information, communication, and technology. And so notice they've highlighted manufacturing. So unsurprisingly, manufacturing would be the sector most impacted by a policy tightening. And then, goes down the list here from most to least impacted. But now, the chart below here, the bottom chart, output price inflation in the first quarter of 2023 relative to 4 years ago. In other words, the bottom chart asks how much inflation has been generated in each of these particular sectors. And so again, let's look at the manufacturing. So that's highlighted. Manufacturing has certainly been responsible for some of the Eurozone inflation, but not as much as agriculture, construction, or trade and hospitality. And so when you have a policy tightening in the Eurozone, that's going to have a big impact on manufacturing, but that's not the main generator of inflation. So, for example, here, agriculture, food prices in Europe have really skyrocketed, compared to lots of parts of the world. That is, and this is important here, so agriculture is where a lot of the inflation has come from, but notice there's a relatively small policy impact from a tightening. And so as a result, here's the idea. The sectors that are generating inflation aren't heavily impacted or necessarily heavily impacted by a policy change. So to get a given reduction in inflation, what that means is you need to do more policy tightening, unfortunately. And so now let's take a quick look at what's called the proxy Fed funds rate, because what I've been doing so far, and this is what pretty typically happens, is folks have been saying, well, the policy stance of the Fed is measured by the federal funds rate. And that's, that may not be true. And the idea is that the Fed funds rate is only one part of monetary policy. You also have, as we've talked about, we have forward guidance and balance sheet operations. These also affect financial and economic conditions. And so what these folks have done is they said, all right, what we want to do is try to include the impact of forward guidance and the impact of the balance sheet on a whole different set of financial market variables, like interest rate spreads, like the slope of the yield curve, and so forth. And then what they do is they use the actual federal funds rate as kind of like a benchmark, and they incorporate those other financial conditions and create the Fed funds proxy rate. Okay, so let's have a look at this. So this is right out of their paper here. And they, by the way, they keep a monthly updated version of this since they've written their paper. And so the blue line here, this is the actual federal funds rate that we've talked about. And the green line, this is the proxy rate. And remember, this includes financial market conditions that are impacted also by forward guidance and the balance sheet. And so notice here, for example, that even in 2021, the proxy rate had already started to increase, caused, for example, by forward guidance, caused, for example, by the beginning of the reduction in the balance sheet. And so when you include those additional things, so if you measure the difference between the proxy rate and the actual federal funds rate, that's about 2 percentage points, give or take. So what that suggests is that thanks to forward guidance and thanks to the balance sheet, the actual policy is 2 percentage points tighter than is indicated by just the regular standard federal funds rate. So in other words, policy is tighter than it actually looks because you have other dimensions of policy. And so what you can do here is you can think, well, all right, so here's the standard policy that's the March 2022 increase in the Fed funds rate. But here's the thing to keep in mind. This proxy rate hit the neutral rate, that neither contractionary nor expansionary federal funds rate in early 2022. And so what happens, or what this suggests, is that policy is really perhaps substantially tighter than as measured by the actual federal funds rate, the one that gets reported in the news that often. And here's the other thing to keep in mind. The economists like to talk about real interest rates. We haven't mentioned real interest rates, so we have to do that now. So inflation, as we've already noted, has fallen pretty dramatically. So when you account for that and the increase in the nominal federal funds rate, the real federal funds rate is now well above zero. And so that tends to act as a more contractionary impact on monetary policy. So here's the main point, is that when you look at the real federal funds rate with inflation falling, and you look at the proxy federal funds rate, including the balance sheet and forward guidance, policy might be much tighter than it actually looks based on just the Fed funds rate. And so what might the Fed do next here? So in their most recent Summary of Economic Projections, their SEP, they ramped down their estimates of the unemployment rate, which is good, but they ramped up their estimates of inflation and GDP growth and the end-of-year Fed funds rate. And the reason for these policy changes, or these forecasts relative to the March forecast, is they've noted a lot of resiliency in the labor market and the overall economy. Consider, for example, the job creation figures we talked about earlier. Consider, for example, a small change they made. Now, what they did is what they do. So this is right out of the policy statement from their July meeting. Recent indicators suggest that economic activity has been expanding at a moderate pace. So that's the current verbiage. The old verbiage here is crossed out. So this is like a track changes move here. They said it had been expanding at a modest pace. So they crossed out modest and replaced it with moderate. Now, to most people, it wouldn't really matter. But in Fed speak, moderate is a stronger descriptor, or a more positive descriptor of economic growth than is modest. And so that upgrade suggests that the Fed is thinking that the economy has been relatively more robust to policy tightening. And so Jerome Powell has made it pretty clear that they are going meeting by meeting by meeting. And so what do financial markets think the Fed is going to do with their next upcoming meeting? So their next meeting is in September right here. And so this is from the CME. They have a very nice feature called the CME Fed Watch. And what it does is it takes federal funds futures contracts, and based on certain assumptions, I won't bother us here with the details, what they do is they use these to figure out the implied probabilities that financial markets think that what the Fed will do at the September meeting. So here, for example, let's look at this column right here. So this is 5.25% to 5.5%. That's the current Fed target. So the way you interpret this is that based on the implied price or the prices of the Fed funds futures contracts, as of the first part of August here, that there's an 85% chance that the target rate in September will be the current target rate, which is 5.25% to 5.5%. And they place only about a 15% chance that the target rate will move to 5.5% to 5.75%. So in other words, only a 15% probability, 14.5% actually, that the Fed's going to increase the federal funds rate at their next meeting. And so what this suggests is that the financial markets think it's unlikely the Fed's going to move at its next meeting. And what's been interesting is that over the last month or so, this probability has been increasing and this probability has been decreasing. So as we've seen moderating inflation data and moderating employment data, financial markets think the Fed is less likely to tighten at the next meeting. So quick summary here. Critically, the future path of policy is substantially less clear than it was even 6 months ago. It could be more costly to get inflation down to 2%, though we talked about the factors that might make it less costly and the factors that might make it more costly. We've talked about that the sectors that are causing inflation might not be the sectors most impacted by monetary policy, and so that monetary policy might have to tighten more than it would otherwise. That the long and variable lag problem complicates the Fed's job in terms of what to do next. And one final thing that we haven't mentioned, that there are these outside forces the Fed still has to worry about. We've all seen the extreme weather, the heat waves and the droughts and the other issues we've had. Those sorts of things tend, for example, to increase food prices. We also have, as always in current times, an escalation of the war in Ukraine in terms of the impact on food prices, the impact on energy markets, and so forth. All right, thank you very much, everybody.